The U.S. economic recovery seems to be moving along, with Fed officials now leaning more towards hiking rates this year. Is the economy really recovering, or is the Fed just trying to get itself out of a corner? Joining us now is investment strategist Scotty George, who thinks the recovery is sufficiently taking root. Scotty, good to speak with you. Good to meet you. Good to have you on the show.
Good to be here. Thank you.
So let's talk the Fed here. What do you make of their latest comments, and where do you think they're headed?
Well, they're treading a little bit lightly right now. They're certainly walking back some of the enthusiasm that they had at the end of last year when they postured higher interest rates for this year. I don't think anything's going to be done before the election, however, so I think the September excitement is going to be muted a little bit.
But do you think, or the question is, what do you think is the real reason behind why the Fed would raise rates? Is it because they really believe the economy is solid? Or is it because they've just been saying it for so long that they kind of have to do it now?
They're not going to gain any traction or credibility no matter which way they go. So it's a win if you lose, lose if you win kind of situation for them. The fact is that interest rates, as being as low as they have been, haven't generated the kind of growth that they anticipated. So I would expect that the Fed is leaning towards raising interest rates de minimisly to try and increase savings levels, to gain a competitive advantage for banks in terms of building up savings assets.
But let me ask you, Scotty, what makes you believe in this economic recovery? Which data did you see that made you think, you know what, okay, this looks substantial, I believe it now?
Well, I'm a quantitative analyst, Daniela, and so what we look at are trends, and the key is the timeline to those trends. We've been in a 7-year plus recovery since the credit crisis, and the data that we're using to substantiate our claim about the recovery is that things are better than they were. It's not any more difficult than that. There's certainly some roadblocks on the horizon. We are as aware of the pitfalls in the marketplace as others, but the trend is moving upwards. And if you open the aperture and examine this over a longer period of time, we're in a better place than we were 7 years ago, and the trend seems right now to be unabated.
So what does this mean for safe haven assets like gold? If you believe in a recovery, what does it mean for the metal?
Well, it's interesting about gold. You know, gold is not only a base element, but it's a metaphor. Gold has been in the lexicon of human language for centuries. It has both a fundamental characteristic as well as subjective characteristics. It's a noun as well as an adjective. So when people talk about gold, you've got to be careful to delineate whether you're talking about the fundamentals of the base element or whether you're talking about people's fears and expectations about what might happen in the market overall. When the market obviously turns defensive, people start to buy tangible assets in quantity, whether it's gold or other things, wood, paper products, steel, copper, zinc. So gold right now has been in a short-term acceleration, but over the last 2 years it's failed to produce as the market has. I think that gold looks attractive if you're looking at a longer-term horizon, and it's certainly appropriate to own some in the quantities which might be defensively oriented.
So do you like gold?
I do. I think that it's appropriate, as are other tangible assets in the commodities sector. We own agricultural stocks. We own other metallurgical companies. Right. But the issue is where it places in the portfolio, to what extent it depicts conservatism versus aggressiveness, and the subjective as well as the fundamental qualities of owning that security.
Now, many experts would suggest, an allocation of anywhere between 5 and 10%. Do you agree with that?
That's big. I think, okay. I mean, in a special situations category in our portfolio, the cumulative sum total would be 6%. So gold would represent an element of that 6% total allocation.
Not much exposure.
I'm not going to overweight anything in this market right now. I think that it's appropriate to be conservative and to take the measure of where the market is after the election.
Well, you have 35 plus years in the business, right? So what are you liking right now? How do you protect yourself as an investor in this marketplace?
Again, Danielle, it depends on the timeline and of expectations of the client. If you're a long-term conservative investor, I think it's appropriate right now not to have more than 50% of your assets in stocks. The remainder in tangible assets, fixed income products, and cash. If you're a short-term investor, I think the market is a little exposed right now. It's been very high relative strength quotients. There's uncertainty about the next several months before the end of the year. I would be cautious, but I would certainly not limit my exposure to the upside potential in stocks. As a sector analyst, I think that this is a tremendous market for demographics, infrastructure, biotechnology, healthcare, water stocks, agriculture, as we mentioned a moment ago. So if your timeline is long-term, and if you're looking at something that could be demographically important for the next 5 to 10 years, this is a market rife with opportunity.
Right, and you also said it's an election year, so that's a game changer, right? Things change.
It is, but we won't know the true agenda of each of the candidates. And by the way, politics is not my area of expertise, market analysis is. But we won't know the true ramification of the election until we know what the policies are, the makeup of the Congress, and the construct of the people's will to have things get done. But irrespective of the election, the market works on its own timetable, and as I said, there are a number of demographic themes, not only those which I mentioned, but infrastructure development, which I think have some resonance in the market for long-term capital gains.
Scotty, it's great meeting you. Thanks so much for stopping by. Great chatting with you.
Thank you, Danielle.
And thank you for watching this edition of Kitco's Gold Report. We'll be back tomorrow. Thanks for watching.